Have many of you heard that the end of the US dollar is near? Everyone seems to be shocked by the enormous national debt of the United States. You probably have a sense of immunity to these kinds of claims and don't believe such scenarios. But today, I'm going to tell you a sad and instructive story about how 10 years ago, the world's reserve currency nearly collapsed because of that same debt. But today we're talking about the forever decaying Europe. Let me introduce you to the Eurozone debt crisis, though it was partly triggered by US actors. Many remember the 2008 mortgage crisis, which led to the collapse of 465 American banks over 5 years. For comparison, before the crisis, only 10 banks had failed in the same time frame. The blow to the banking sector was severe, and I bet you don't feel too sorry for the bankers. A bank collapsed. Well, serves them right. But the problem is that the banking system is the provider of the money supply, the fuel for economic growth. And what about inflation? Hold on, we'll get to that. After World War II, European countries realized that long-term peace and stability on the continent required close economic and political cooperation. In 1951, the European Coal and Steel Community was established, marking the beginning of Europe's integration process. This union was the precursor to the European Economic Community, EEC, founded in 1957 under the Treaty of Rome. One of the key goals of the EEC was to create a common market and ensure the free movement of goods, services, people, and capital. However, deeper economic integration required coordination of the member states' monetary policies. The first steps in this direction were taken in the 1970s, when Europe faced several currency crises due to the instability of national currencies relative to each other and the US dollar. The first serious move toward a unified currency came with the 1970 plan proposed by Luxembourg's Prime Minister Pierre Werner. Werner's plan aimed to create an economic and monetary union in Europe and introduce a single currency within 10 years. However, due to economic crises and political disagreements, its implementation was delayed. In the late 1970s, European countries once again attempted to stabilize their exchange rates. In 1979, the European Monetary System, EMS, was created, which included a mechanism for stabilizing exchange rates and foresaw the creation of the European Currency Unit, ECU, a precursor to the euro. The ECU was used as a unit of account in intergovernmental transactions and was linked to a basket of European currencies. The real breakthrough on the path to the euro came with the Maastricht Treaty, signed in 1992. This treaty laid the foundation for the European Union, EU, and set the stage for the introduction of the single currency. Under the Maastricht Treaty, EU countries committed to reducing government budget deficits, inflation and interest inflates, and maintaining the stability of their national currencies. On January 1st, 1999, the euro was officially introduced in non-cash transactions. At this stage, the euro was used for banking and international transactions, while the national currencies of the participating countries continued to exist as physical money. In these non-cash operations, the euro replaced currencies like the German mark, French franc, and Italian lira. So for every deposit made in a bank, a loan is issued. The more deposits are made and loans given, the more money circulates in the economy. This increases consumer demand and economic activity. But you can only expand the money supply up to a point where there is full employment and minimal unemployment. If you keep printing money beyond that point, it will cause inflation. Something similar is happening in Russia right now. The budgetary boost has fueled orders for military production. The multiplier effect has spilled over into neighboring industries, and unemployment has dropped. If the government continues its loose monetary policy, inflation will increase, which the central bank is trying to combat. On the other hand, if there's too little money in the economy, unemployment, there's demand, but producers can't sell their goods because people don't have money. Business closures lead to layoffs, unemployment rises, and the economy sinks into depression. This is exactly what the world faced in 2009. The banking sector shrank, Depositors' confidence was undermined, credit requirements increased, and the growth rate of the money supply to nearly zero. The financial system and the economy came to a halt. Now the key question, what's the fundamental problem with the euro? One currency for many different countries. In most countries, there's a central bank and a national currency, with the money supply regulated by that bank. In times of crisis, the central bank lowers interest rates to increase the money supply, stimulating the economy. But the European Union is made up of many countries with a single currency, the euro. The money supply is regulated by the European Central Bank, ECB. However, the impact of a crisis varies from country to country. After 2008, the situation looked like this. One prosperous European country quickly recovered from the mortgage crisis, while another country was hit much harder. The ECB lowered the interest rate from 4% to 1%. Banks started borrowing more, the amount of euros in circulation increased, and the economy began to recover. For the first country, this was enough, but if you keep flooding it with money, it will lead to inflation. Meanwhile, the second country remains in crisis. Banks are collapsing, investors are fleeing, businesses are closing, and unemployment is rising. The solution might seem obvious. Lend to the banks of the first country at a low interest rate and to the second at a higher rate. But this would lead to arbitrage. The banks in the second country would take cheap loans from the ECB and lend them to the first country. The money meant for the second country's recovery would flow to the first, further fueling inflation there. So what can the second country do when the central bank's actions are insufficient and the economy continues to slide into crisis? The answer to this was given 70 years ago by U.S. President Franklin Delano Roosevelt and British economist John Maynard Keynes. The government needs to increase its spending. As if the central bank doesn't want to flood the economy with money, let the government budget do it. Did it work for Roosevelt? That's a matter of debate. On the one hand, the New Deal, which ran large budget deficits, did stimulate demand and brought the economy closer to pre-1929 levels. On the other hand, the main driver of recovery wasn't the government program, but World War II, which brought military contracts and jobs to the U.S. Can this be compared to modern-day Russia? It's debatable. The U.S. is a unique country. It can afford to run budget deficits and grow its national debt because it prints dollars, which are in demand worldwide. But what can a small European country offer to the world to allow it to take such measures? Let's look at the Eurozone's top performers. After the crisis, countries like Germany, Austria, Finland, and the Netherlands demonstrated responsible fiscal policy. They ran balanced budgets and reduced their national debts. Now let's look at the countries that were hit harder: Spain, Portugal, Italy, and Greece. These countries, known as the pigs, sometimes include Ireland too, but it's often left out as the acronym sounds better without it. For these countries, the crisis dragged on. Unemployment grew, businesses shut down, banks collapsed, and investors lost faith in their economies. This led to unemployment levels in the pigs countries being much higher than in the top performers of the Eurozone. For example, by 2010, Germany's unemployment rate had dropped to 5%, while in Italy and Greece, the situation remained critical. The European Central Bank, ECB, faced a tough dilemma. If it continued loosening monetary policy, inflation would rise in countries like Germany and the Netherlands. However, tightening policy would strip countries like Portugal and Greece of the ability to fight the effects of the crisis. Yet, the ECB's mandate is to control inflation, not to foster economic growth. In the end, the ECB chose to focus on controlling inflation, leaving the pigs countries to solve their problems without a magic money printer. These countries had no choice but to issue government bonds to support their budgets, which they did. The situation was so dire that by February 2012, economists at Citigroup coined the term Grexit, predicting Greece's potential and, at the time, seemingly inevitable exit from the Eurozone and return to the drachma as its national currency. They raised their estimate of Greece leaving the Eurozone to 50% within the next 18 months, up from previous predictions of 25 to 30%. You might think this is an allusion to Brexit, but no, it's the other way around. The term Brexit appeared later, a few months after Grexit, following its example. Though the Greeks probably aren't proud of being trailblazers in this regard, it's also little known that in mid-2012, an entire plan for leaving the Eurozone was developed. In the introduction, it stated that until recently, no one had even thought about such plans. The work was titled Withdrawal from the Euro, a Practical Approach, and it was so serious that it won an award. This plan could have been used not only by Greece but also by any country with similar problems, such as Portugal or Italy. Imagine Italy, one of the founding countries of the European Economic Community, abandoning the euro. It's hard to imagine the reputational blow this would have dealt to the single European currency. The tension was so high that even betting companies were offering odds on the Eurozone ceasing to exist by the end of 2012. In this sense, Grexit wouldn't have been as damaging to the euro itself as Brexit was. The British never adopted the euro, so their departure wasn't tied to abandoning the single currency. But in 2012, catastrophe was avoided. Greece didn't leave the Eurozone, and the European Union continued to support it. For 8 years, the EU provided Greece with loan tranches and bought its government bonds, ending the financial aid program only in 2018. This didn't save Greece from declaring default in 2015, but if you Google Greece currency today, the answer is still the euro. Similar support measures were extended to other PIGS countries, though on a smaller scale. Essentially, Northern Europe spent several years buying up the external debt of Southern European countries. Can we say this story had a happy ending? For the average citizen of Greece or Portugal, it might seem so. Unemployment has gradually fallen. Shops still accept euros. The banking sector is stable, and GDP has started to grow. But has anything changed in the structure of these countries' economies? Hardly. They receive temporary support but no long-term solutions. In essence, these countries had to run just to stay in place. Greece, for instance, was effectively under external financial management until 2018. Nevertheless, Europe learned some lessons from the crisis. As is often the case, solving one set of problems creates new ones. In the wake of the debt crisis, strict limits were introduced for Eurozone countries. For example, the budget deficit must not exceed 3% of GDP, and government debt must be capped at 60% of GDP. But how did Greece, with debt exceeding its own GDP, manage to join the Eurozone with these requirements in place? The answer is simple: they fudged the statistics. The European Union must be more stable than a marriage, or no one will believe in it. That's why closer attention should have been paid to the situation before allowing countries to join the Eurozone. It's true that Greece became a member of the Eurozone in 2001 by falsifying its statistical data, and to this day, some politicians blame themselves for it. Since then, Europe has learned to be more cautious. Today, Eurostat, the independent statistical office of the EU, has the authority to thoroughly audit the financial fall member countries. However, creative accounting wasn't only used in Greece, it's also been seen in other countries, including Italy, Spain, and even Germany. But that's just part of the problem. The main issue is that countries must strictly adhere to the limits set by the Maastricht criteria, which has serious consequences for nations with high levels of government debt. Strictly following these rules means that countries in difficult economic situations are deprived of not only monetary but also fiscal stimulus. All they can do is watch as their economies sink into recession, unable to take action. One possible solution could be a quantitative easing program, where the government debt of struggling countries is purchased by the European Central Bank, ECB. This would allow them to increase government spending to maximum levels and then sell their debt obligations back to the ECB, repeating this process until the recession is overcome. This is essentially a repeat of the measures the ECB took for the PIGS countries in 2010, but with a proactive approach rather than waiting until a default looms. So the Eurozone managed to overcome the debt crisis without losing a single country. Part of the debt was bought by the European Union to prevent further growth, and the rest was restructured, allowing the countries to service their obligations. Additionally, European officials and economists learned important lessons and now pay much more attention to the financial discipline of EU member states. To support economic stability, the European Financial Stability Facility, EFS, was created. While it's impossible to completely rule out a repeat of the crisis, Europe is now much better prepared for such shocks than it was 15 years ago. Unemployment has significantly decreased, although systemic problems within the currency union still exist. The PIGS countries continue to lead the negative rankings in terms of national debt, and their GDP per capita remains significantly lower than that of the Eurozone's top performers. Moreover, countries like Latvia and Croatia have recently joined the Eurozone, and their macroeconomic resilience may also prove insufficient in the face of the next crisis. The situation has certainly improved since the crisis, but it's too soon to relax. This story illustrates a classic problem with integrating players of different strengths. The weaker ones aren't always able to follow the rules set by the stronger ones. On the one hand, it might seem like weaker Eurozone countries like Greece or Portugal are a burden. Why continue to support them and spend money on them? In that case, one might logically suggest removing them from the Eurozone or even from the European Union altogether. On the other hand, a softer approach could be considered preserving the European Union but abandoning the single currency, returning to national currencies. This would allow countries to manage their monetary policies independently. Here we encounter a classic question of integration. Does the new member meet our requirements? If not, are we willing to carry them? Even if we overpay, what do we gain from their membership? It's crucial to get the answer right. And when it comes to the Eurozone, the situation is complex. We should remember that the introduction of a single currency was tied to the idea of simplifying economic interaction between EU countries. A single currency makes trade easier, attracts investment, and supports stability within the Eurozone. However, the economic and political realities of different countries have proven to be vastly different. For example, Germany and Greece had to take completely different measures to overcome their respective crises, creating an imbalance within the currency union. The lessons learned from the Eurozone's debt crisis have profound implications not just for Europe, but also for the US. The situation with the euro serves as a warning for those who view the dollar as an absolute guarantee of stability. Since 2008, the US national debt has grown from $10 trillion to over $31 trillion, and the pace of its increase is causing serious concern. Considering that more than 40% of the country's debt is held by foreign creditors, any loss of confidence in the dollar could lead to a sharp depreciation. Imagine a world where the dollar ceases to be a reliable currency and its status as the global reserve currency begins to erode. This isn't just a science fiction scenario. It's a real threat that the United States may face if it doesn't take action. Looking at history, it's worth noting that in 1971, President Nixon ended the gold standard, opening the door for unlimited dollar issuance. However, this very practice could become a ticking time bomb. According to the Federal Reserve, the amount of dollars in circulation has doubled over the past 2 years, creating a risk of inflation that is already starting to accelerate. In 2021, inflation in the US reached 7%, the highest rate in the last 40 years. Do you think the dollar will be able to withstand these growing threats? Will US authorities take the necessary steps to maintain confidence in the currency? Or are we on the brink of a new economic reality where the dollar is no longer the undisputed leader? Let us know in the comments. And if you enjoyed this video, please like and subscribe to the channel. See you in the next video.